Futures research is a set of distinct research approaches in predicting and anticipating future conditions. In line with UPOU's articulation of the University of the Future, the series of talks in Research Conversations 2020 features experts in scenario building, multivariate trends analysis, simulation approaches, decision support systems, and modeling. Through this forum, we hope to enlighten and capacitate faculty members and researchers, and in the process, enrich our research outputs.
Hello, everyone, and welcome to another Research Conversations 2020 Futures Research webinar series brought to you by the Office of the Vice Chancellor for Academic Affairs in collaboration with the Faculty of Education. I am Jessica, and I will be the moderator for today's webinar entitled Hidden Markov Model in Commodity Market. And to give us a little background, today's talk will focus on how the hidden Markov model can be used to describe the behavior of fluctuations in the price of commodity. Also, this could serve as a risk management mechanism against both inflation and economic downturn. Definitely sounds interesting, right? And I know a lot of us are excited to learn from our speaker today. But before I introduce our speaker for today, I would like to give a few reminders. First, questions will be addressed after the speaker's presentation. So if you have questions, please type them in the comment section or chat room of the platform which you are using in viewing this live stream. We are streaming live in different platforms such as UPOU Network's website, UPOU Multimedia Center Facebook page, and UPOU YouTube channel. Second, kindly take note that the evaluation form for this webinar will be made available at the end of the program. Please do not forget to accomplish the form in order to receive the e-certificate. So stay tuned and wait for the link and the QR code. Also, please take note that our evaluation form is only available within 1 hour after this live stream. I hope you were able to take note of those reminders. And now, let me introduce our speaker for today. He is currently an assistant professor in the Institute of Mathematical Sciences and Physics in the University of the Philippines, Los Baños, and for almost 2 years, he also served as the head of the Mathematics Division. He earned his bachelor's degree in applied mathematics, also in UP Los Baños, where he graduated cum laude. He completed his master's degree in applied mathematics in UP Diliman and is now on his way to completing his doctorate degree in mathematics, also in UP Diliman. In the year 2015, he was awarded with the UP International Publication Award. He had completed numerous journal articles and even presented various research papers across the nation. And he also actively participated in national and international conferences. And you know, just last year, he participated in the Abdus Salam International Center for Theoretical Physics in Trieste, Italy. Lastly, his areas of research expertise are actuarial science, mathematics of finance, and stochastic analysis. So everyone, let's give a warm welcome to Mr. Jonathan B. Mamplata.
Hello, everyone. Good morning. I hope you are ready today to learn some new topics or concepts. Let me share my screen. For today, we'll be talking about hidden Markov model in commodity market. Just to give you an outline of my talk, So this will be our presentation for today. First, I will introduce to you with the commodity market, specifically the research that I take into, and they are on precious metals and electricity. And of course, I will be talking about what are futures in the market setting and a basic introduction of the hidden Markov model. And in the fourth section, we'll be taking or we'll be considering some preliminaries and mathematical concepts. So we'll be more technical in this chapter, and I will show you some numerical implementation of the algorithms that I have considered and some application and conclusion of the research that I made. So let's start with commodity market. What is a commodity market? Commodity market is a market that trades primary economic sector. Basically, they are raw materials rather than manufactured products. So examples of commodities that are being traded in the commodity market are rice, grains, precious metals, oil, livestock, poultry, and even currency. In my research, I considered precious metals for the reason that they are hard commodities since they are mined from the ground. They are rare, valuable, and have various utility in different industries. Also, these commodity are easy to store or warehouse, but of course, if we store this commodity, it requires some cost, and that is storage cost. And in my research, I considered four precious metals. One is gold. They are durable, malleable, and conductor of heat and electricity. They are base of for jewelry and form of currency. And gold trades predominantly as a function of sentiment. Another precious metal that I considered are silver. Silver has a very tangible role as an industrial metal. The price of silver is more volatile than gold, so it fluctuates more often than gold. Platinum tends to fetch a higher price than gold, and platinum is much rarer than gold. And lastly, I also considered palladium, and much of these precious metals are used in automotive industry. And if you want to have palladium, you should buy bullion coins and bars. An illustration of that is shown in the next slide. In the upper portion, they are the bullion coin. In the lower portion, they are the bullion bars. So if you want to have palladium, you should buy those bullions. Another commodity that I considered are electricity. These must be consumed once they are produced. That is actually the old concept of electricity, that once the electricity are consumed, you should use it or you should consume it because electricity cannot be stored. An illustration of how buying of electricity works is from a generator. The generator, they are the manufacturers of electricity. And once the electricity is produced from the generator, it will be transferred to the reseller or a spot market where the trading of electricity uh, is being done. And the end user or the consumer of the electricity will go to the reseller wherein they will buy electricity. So reseller are actually the medium on how to trade electricity. And as I've mentioned a while ago, electricity must be consumed once they are produced. So the bidding process is being done in the spot market wherein the delivery of electricity is delivered on the date that it will be produced. Now, this spot market is, I mean, the prices in the spot market of electricity or other commodities are very fluctuating, okay, very volatile. That's why we can consider or we can use the concept of futures. In the market setting, what do we mean by futures? Futures are actually financial contract obligation, obligating the buyer to purchase an asset or the seller to sell an asset and have a predetermined future date and price. A futures contract allows investor to speculate on the direction of a security, commodity, or a financial instrument. Futures are used to hedge the price movement of the underlying asset to prevent losses from unfavorable price exchanges. So what do we mean by futures? Futures are actually contracts by which you set the price now, but the delivery of the commodity will be done sometime in the future. So let's say, for example, you want to buy electricity. But instead of buying the electricity at a spot, you may want to enter a contract, a futures contract today, so that today we can negotiate the price. And once we have negotiated the price today, let's say you want to buy the electricity after 1 month. Once we have negotiated the price today, whatever the price of the electricity after 1 month, the price of the electricity written in the futures contract will be the trading price. This will actually minimize the risk of having so much fluctuations in the trading of electricity. Now, another concept that is very new in the futures market or in commodity market is what we call convenience yield. Convenience yield is actually more of the relationship between the spot price and futures price of the commodity. Convenience yield is a benefit associated with holding an underlying product or physical good that is actually synonymous to dividend. If you are familiar with stock market or shares of a company's asset, okay, at specific intervals of time or at a specific periods of time, you get dividend. So we can associate convenience yield as a dividend in commodity market. Let's have some mathematics here. All right. In that expression, take note that S sub T is the spot price, okay? And the futures price of a commodity is determined by that formula. Take note from that formula, U is the storage cost, R sub S is the risk-free interest rate. This could be T-bills or T-notes or T-bonds. Delta sub S is what we call the convenience yield. In this concept, when we say convenience yield is that a commodity has the capacity to be stored in a warehouse or in a specific place wherein instead of buying the futures or instead of going into the futures market to buy the product or to buy the commodity after some period of time, you can actually warehouse or store that commodity so that when the time that you need that commodity, you have an easy access to consume that commodity. So basically, you are giving yourself some kind of convenience that instead of going into the market to buy or to get the commodity, you have a warehouse when you can just easily consume the commodity or easily get the commodity from that warehouse. The interesting thing about the electricity nowadays is you can actually store electricity. This is an illustration of electricity storage that is actually, you can think of it as a very, very big battery located in the US. That is actually, I think, the Connexus Energy project uh, that was built in 2017, wherein you can store electricity in that warehouse. Okay, so since nowadays you can store electricity, so there is some kind of convenience of acquiring electricity, not from the generator or not from the producer of the electricity, but from that warehouse. So the concept of the concept of convenience yield now will factor into the pricing of electricity. Also, if, of course, in precious metals, since it can be easily stored, we can also use the concept of convenience yield in pricing or in determining or in analyzing the price of the precious metals. So that's about commodity or commodity market. Now, how will we use HMM or hidden Markov model in pricing and in analyzing the fluctuations of the price of these commodities? Let me give you an illustration of a hidden Markov model. From that figure, take note that the variables y1, y2, y3, y4, they are actually our observed process. That are the values that you observe or that are the values that you see from the process. We have here the state process, x sub 1, x sub 2, x sub 3, and so on. These state process, they are hidden process. They are the processes that you don't see but really affects the observed process. And a transfer from one state to the other state is given by some are given by some probabilities called transition probabilities. So those state process actually determines our Markov chain. And from the state process, it emits some probabilities called emission probabilities. So that it will give you values for y or the observed process. Let me give you a basic example or a brief example of this hidden Markov model. So for an illustration, suppose that in a given area or in a given city, there are only two weather patterns. It is on a given day, it is either sunny or rainy. And a person, let's say his name is Bob. Let's say a person, his emotions or his feelings highly depends on the weather in that area. Let's say, for example, he has two feelings or two emotions. He's either happy or grumpy. If the weather is sunny, he is more likely to be happy than grumpy. If the weather is rainy, he is more likely to be grumpy than happy. Now, let's say, for example, a person who is every day talking to Bob, okay, wants to determine the weather patterns in the region. But he cannot determine at once the weather pattern, maybe because he is from the other side of the world. So he will just, or that person will just determine the weather patterns based from the emotions that Bob is emitting when they are conversing. And let's say, for example, that we are given some probabilities that Bob is, if it is sunny, there is a probability of zero point 0.8 that Bob is happy, and there is a probability that Bob is grumpy with zero point 0.2. Let's say, for example, on a given day it is rainy, Bob is grumpy with probability zero point 0.6, and Bob is happy with probability 0.4. Now, the weather patterns changes according to these transition probabilities. So being sunny and rainy on a particular day are what we call states. And suppose today is sunny. The probability that tomorrow will also be sunny is zero point 0.8, and the probability that tomorrow will be rainy is zero point 0.2. And suppose, for example, today is rainy, the probability that tomorrow will also be rainy is zero point 0.6, and the probability that it will be sunny is zero point 0.4. Now, what is the main problem here? This is what we see. The series of emotions from day one and so on. Suppose you have observed these emotions. Today is grumpy, the next day Bob is happy, 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 then grumpy, grumpy, happy, grumpy, happy, 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 grumpy, grumpy. So those are the only information available to you. And what are the basic questions that can be answered by the hidden Markov model? There are actually four basic questions that can be answered by HMM. How do we find these probabilities? If we are given this observed process, how do we determine that the weather is sunny on any random day? How do we determine that the weather is rainy on any random day? Another question that can be answered in HMM is, what is the probability that a random day is sunny or rainy? Oh, sorry. The first question actually determines the entire probability, the probabilities that I've shown you a while ago. Well, the second question actually determines the probability that on any random day it is sunny or rainy. And the third question that can be answered by hidden Markov model is, if today he is happy, what is the probability that it's sunny or rainy? Let's say, for example, uh, today Bob is happy. What will be the probability that the weather today is happy? And if he is happy, what is the probability that today is rain? If for 3 days Bob has these emotions, happy, grumpy, happy, what was the weather for those 3 days? Well, basically, those questions I will not answer at this time due to time constraint. But for more details, you can watch this basic introduction of the hidden Markov model by Luis Serrano, and you can find it in that link. All right. Now, what's the basic idea in my research and the hidden Markov model? What I am looking into are the fluctuations of the prices of the commodities. But first, but in this discussion, we will only consider precious metals. All right. And in the precious metals, the prices of the precious metals changes dependent on the state of the market. In the market, we don't know how many states there are. It could be when we say that the state is good, the market is rising up, or when the market is bad, the prices of the precious metals goes down, or it could be neutral. But we don't know how many states there are. Okay, so that's basically the assumption I have considered in this framework. Another one is, again, the prices depends on the state of the market. So what I am seeing are actually the prices of these precious metals. And from that prices of precious metals, I have to determine the number of states and the parameters of these states. When we say parameters of these states, we will consider a pricing model in the prices, and we determine the parameters of that model. So basically, we start with this some preliminaries. So I will be technical about here. I will be technical on here. So here we let Z sub k to be a Markov chain supported by some probability space omega fp. And that Markov chain is given by that expression, Z sub k plus 1 equals A zk plus vk plus 1. In stochastic analysis, capital A is the transition probability matrix. That is actually a matrix that determines the probability of transfer from one state to the other state. The second term on the right-hand side, V sub k plus 1, the expected value of that is equal to 0. That is commonly known as the martingale increment. And take note from this expression, our Markov chain zk actually the state of the process. So meaning to say, if you have a two-state process, in our example a while ago, if it is either sunny or rainy, then z sub k is a vector of order 2. If we have a three-state process, then z sub k is a vector of order 3, and so on. And in my case, I considered m states. Okay, and later I will determine the value of m. Okay, here e sub k or e sub I, okay, this is actually a canonical basis of r sub m. E sub I says that that is actually the state of the process. So let's say if we have e sub 1 is a vector 1 on the first component, 0 elsewhere. So meaning to say you are in state 1. E sub 2 is a vector wherein you have 1 on the second component and 0 elsewhere. So that means that you are in state 2. Here, z sub k could be any of the e sub I from 1 to the number of states. Here I consider to be m. And in stochastic analysis or in stochastic calculus, this expression z sub k plus 1 equals a z sub k plus v sub k plus 1, that is called semi-martingale process. Now, geometric Brownian motion is the basic assumption for the price changes of the prices of the commodity. So here, we let S sub t, or the spot price of the commodity, or in our case, the price of the precious metals, and it follows that stochastic differential equation. D S sub t equals mu S sub t dt plus sigma S sub t dwt, wherein mu is the drift of the process or the average value of the price. Sigma is the volatility of the process. This is how the prices of the commodity fluctuates. W sub t is a winner process satisfying the following conditions. It starts at 0, so W sub 0 is 0. W has independent increments, that is W sub t plus u minus W sub t are independent of the past values. And the cumulative distribution function corresponding to the winner process is given by a normal distribution. So that is given by that expression. So basically, winner process is a Gaussian process with mean 0 and variance t. Okay? So the geometric Brownian motion are actually classic or basic differential equations in stochastic analysis. Now, in the previous slide, S sub t is in a continuous time process. Now, what we are going to do is we will discretize that process And we assume here that x sub k is the logarithm of the returns process, x sub k, s sub k over s sub k minus 1, where the logarithm here is the logarithm with base e, or the natural logarithm. And it can be shown that x sub k plus 1 is equal to f of z sub k plus sigma of z sub k epsilon sub k plus 1. And take note here that f is actually mu minus sigma squared over 2, where mu and sigma are the parameters of the model. As I've mentioned to you a while ago, we have m states. So since we have m states, we will be having m sets of parameters. In our geometric Brownian motion, we are considering two parameters, mu and sigma. And since we have m states, so we should have m values for mu and m values for sigma. Meaning to say here, mu sub 1 and sigma sub 1 are the parameters for state 1. Mu sub 2, sigma sub 2 are the parameters for state 2. Up to mu sub m and sigma sub m are the parameters for state m. So basically, our goal is to determine these values and also the transition probability matrix. And in order to do that, we will be using some probability concepts. The first one is we have to transform the usual probability that we have a while ago into a new probability measure. So we will define another uh, measure or another way to compute probability, and that is given by P bar. P bar is a new probability measure such that x sub k is a standard normal uh, random variables. They are independent and identically distributed random variables, and the Markov chain is independent from x sub k. In the previous probability measure, we don't know if the Markov chain is independent or dependent from the state process or from the observed process. But in the new probability measure that we are defining now, we want the Markov chain to be independent from the observed process, for the reason that it is very easy to compute values of the parameters if we know that the Markov chain is independent from the observed process. And also, since we have set that x sub k are standard normal, identically and independent and identically distributed random variables, it will be easy to compute the parameters. And in order to achieve that transformation, we will be defining a Redon-Nikodym derivative, lambda sub L, given by that expression, where phi here represents the cumulative distribution function for standard normal random variable. And the Radon-Nikodym derivative is given by that expression, dp bar over dp, subject to the complete filtration generated by x sub 0 to x sub k, and the state process z sub 0 to z sub k. So that capital lambda sub k is just a product of small lambda sub l. Also, in order to achieve some parameters, we will be defining the state processes, J sub k, O sub k, and T sub k, and how these processes mean. Now, what are these processes? J sub k is actually the number of jumps from state I to state j up to time k. So j sub k actually counts the number of jump or the number of transfer from state I to state j. Let's say, from example, uh, you will just count how many times the process transferred from state 1 to state 2. And you are given a very specific period of time, up to time k. Okay? O sub k is the occupation time. That is the amount that z sub k spent in e sub I. Basically, O sub k is the sum of all values of j sub k. T sub k here is an auxiliary process that is similar to an occupation time, but you have another function here, h of x sub l, wherein the value of h here will be determined after you have solved the parameters of the model. But take note that in this process, we know the values of the states. But in reality, we don't know what are these states. So in order to achieve the values for this filtering process, we need to have some approximations or estimations. And in order to approximate or estimate these values, we will be using some probabilities. And the basic rule or the basic method that we will be using in transforming or in estimating these processes is Bayes' rule or Bayes' theorem. If you are familiar with conditional probability, so Bayes' rule is just a generalization of conditional probability. And also, in order to achieve some estimates, we have to define these quantities. So the state process, take note in the usual probability setting, P, our state process is given by Z sub K. Since we transform our probability from P to P bar, we should also transform the state process from Z to C. So that is the first defined quantity in that slide. Another is gamma sub j. Sorry, this should be lambda sub j. Lambda sub j is actually the Radon-Nikodym derivative of a specific process at given x sub k plus 1. Okay? D sub k, the third definition, you just actually since from the second definition, we define lambda sub j, okay, and we have m states. So so we will be having m lambdas, and those m lambdas will define the matrix D, and those lambdas will be written in the diagonal of that matrix. And because of those definitions, we will be having these estimates. The first one is an estimate for the state process. The second is a theorem representing the estimates for the process I have defined a while ago. So gamma here is an estimate for J, capital J. Gamma O is an estimate for capital O. Gamma T is an estimate for the process capital T we have a while ago. Now, actually, using these estimates or using these approximations, we can determine now the parameters of the model. So there are some algorithms or methodologies in order to determine the parameters. The usual methodology or the usual algorithm that is being used is what we call maximum likelihood estimation. In maximum likelihood estimation, we are assuming a specific process to the observed process. Let's say we assume that the process is normally distributed. If the process is normally distributed, So we will fit those points into a normal distribution to get the mean and variance of the process. But in our case, since we have a geometric Brownian motion process, it is very difficult to determine the values of the parameters using the usual maximum likelihood estimation. So in order to achieve a good estimate of the parameters, we will be using this algorithm or the EM algorithm, or commonly known as the expectation maximization algorithm. In the expectation maximization algorithm, take note that we will be solving the process or the estimates of the parameters mu sub I, sigma sub I, and a sub ij. Those are our goal to determine the values of that. And in order to do that, we should define another probability measure with respect to theta. Theta here is the set of parameters that we have. Okay. And the goal is to find the value of theta to maximize our capital L. Capital L here is the likelihood function. So we need to maximize the likelihood function in order to determine the best estimate for theta. And in doing that, again, we will use expectation maximization algorithm. And using that algorithm, we have this theorem, and this is actually our main theorem that will give you an estimate of the parameters. Take note, A sub ji here is the transition probability. That is the probability of transfer from state I to state j. Take note that the expression is in terms of j and o. Okay, but if we know exactly the values of j and o, we don't need gamma. Okay, but since the state process is unobserved or hidden, we need an estimate for that. That's why we have those gamma. Okay, so that is an expression for the state probability. That is an expression for the mean of the process. That is an expression, or equation number 10 is an expression for the volatility of the process. Okay. Now, using the algorithm that we have, okay, I will go now to the numerical implementation or the main results of my research. So basically, this is the data that I have. Those are the prices of the precious metals that I've mentioned to you a while ago. Okay. So take note here, black, the black curve or the black graph is the graph of the prices of gold. Red here are the prices of platinum. Green red are the prices of palladium. Green are the prices of platinum, and blue are the prices of silver. And based from that, take note that they are really fluctuating. But you cannot see clearly the fluctuations in silver because the prices of silver are relatively small compared to the other three precious metals. But we'll focus on the main results. These are actually the estimates of the mean of the precious metals. Here, I considered two states, okay, state 1 and state 2. But also, I computed for the parameters in a different number of states setting. But for illustration purposes, I will just present to you the two-state process. Take note from this illustration or from this figure, somewhere in 2006 or 2006, the mean of the process diverges from one another. And if you will recall, there is a global financial crisis in 2008. And the global financial crisis was actually the the start of that crisis actually started from 2006. Okay, and that could be the main reason why the two uh, two sets of parameters are diverging from each other. Okay, but of course, we need some more tests, or we need some more evidence that it is indeed the reason for these diverging parameters. Notice from this, it is evident that there is actually more than one state in the given price process. This actually accounts for the mean of those precious metals. In the next slide, I will be showing to you the estimates for the volatility of the price process. Take note that from this illustration, if you notice the blue lines or the blue curves, those are lower in values. And I will just go back to the previous slide. In the previous slide, you will notice the blue curve are relatively higher compared to the red. So an explanation of that is state one. Okay, we can consider the blue curve as state one. State one could be an indication that the market is good. When we say that the market is good, prices of these precious metals are increasing, and also the volatility are very small. So the market is good. State 2, if you notice the values for mu, or the values for the mean of the process, are basically less than 0. And if you will go back to the volatility process, the volatility are high. Okay, so it could indicate that the market is bad, meaning to say prices are going down and fluctuations of these prices are very high. Okay, and this actually accounts for the transition probabilities that I have mentioned to you a while ago. Notice from this, very interesting is the region here. Okay, the region after 2005. Okay, right after 2005. That is also the region that the parameters are diverging in the previous slides. Okay, so this could actually indicate that there is an economic turmoil in that region or in that period. So again, uh, one valid reason for that maybe is due to the global financial crisis that happened in 2008. Now, where could we use these parameters, or where could we use these estimates? So I will be presenting to you some applications, but I will not go into the details of it. In in the discussions a while ago, I have mentioned to you that we considered a geometric Brownian motion, but I have not yet incorporated convenience yield to that process in the discussion. So one application of that is we could also incorporate convenience yield to the process. And there are some literatures that says that convenience yield follows this process, the second line in the equation. They are known as an Ornstein-Uhlenbeck process. And here we have two winner processes. And these two winner processes have correlation rho. So it is also worth considering this kind of process, which is a multi-factor model of the geometric Brownian motion. I have yet to determine the parameters of the convenience yield on a hidden Markov model, but a friend of mine from Cosenza, Italy, have already solved this problem on a one-state process. So another application is on investment strategies. Of course, with the parameters that we have generated or we have estimated a while ago, we could use that to fuel our investment. So investment strategies that I considered or that can be considered in the process are asset only strategy, pure switching strategy, mixed switching strategy, and the Markovitz strategy. When we say asset only strategy, it means that you only invest in one precious metals. Pure switching strategy means that on a given time period, you switch from a precious metal to another precious metal. In a mixed switching strategy, so this is just basically giving weights to your portfolio. How much will you invest in gold? How much will you invest in silver? And so on. And in my research, I actually considered the Markovitz portfolio analysis or the mean variance analysis. In this, uh, in this strategy, we want to have the maximum gain. So I maximize mu and also minimize the fluctuations. So minimize the volatility. And I consider that in my paper or in my study. Another thing that you could use to these parameters is pricing derivative securities under a multi-state, multi-factor, and multivariate framework. So the classic applications of that is pricing European style options, American style options, Asian style options. But in my study, I considered rainbow options. All right. So for the conclusion of this talk, salient features of the multivariate prices of these precious metals were adequately captured by the regime switching algorithm through a hidden Markov model. Presence of more than one market state in precious metals prices is evident through our hidden Markov model analysis, and that is depicted by different or diverging parameter estimates. Then the natural research direction is an inclusion of multi-state framework in pricing derivative securities. This will be carried out by extending the Gersanov principle to find the appropriate risk-neutral measures via a filtered market. And this is actually the main undertaking in our next project. Of course, the parameter estimates we have a while ago, we also validate these estimates, and we incorporate several validation techniques to determine if these are good estimates. So we have used some error measures. We also use bootstrapping method. We also use information criterion method to validate these parameters. And of course, I would like to acknowledge uh, OVPAA through their faculty reps and admin staff development program for the travel and research expenses, because part of my research was done in the Department of Statistics and Actuarial Sciences in University of Western Ontario in Ontario, Canada. And of course, I would like to acknowledge my mentors, Dr. Roger Mamon, which is the chair of the department when I am doing my research in Canada, and Dr. Guido David, my mentor from UP Diliman. And these are the references of the research undertakings. So I think that's all my talk for my talk. Thank you for listening.
Thank you, Mr. Jonathan. That was indeed an informative presentation about the hidden Markov model and how it can be used in the commodity market. Personally, I'm not that quite familiar with this model, but because of this presentation, I got a little understanding of it, and it's very informative, very interesting. So thank you so much, sir. And now we are going to have our question and answer. So for those of you who have questions, so kindly comment them in our on our comment section or chat rooms. So we have the chat room in UPOU Multimedia Center multimedia webpage, and then we have the chat rooms in YouTube and Facebook. So now I will give the floor to Mr. Arman for the question and answer. Mr. Arman?
Thank you very much, Ms. Jessica. Hello, everyone. I am Arman Santos, a graduate student of the UPOU and an associate professor from the Polytechnic University of the Philippines. I will be your moderator for the Q&A of today's Futures Research webinar series on the hidden Markov model in commodity market with Assistant Professor Mamplata. Before we formally start our open forum, I would like to remind our audience to post their questions in the UPOU Network chat box and or post your questions in the comment sections in our Facebook page and YouTube channel live streaming. Kindly indicate and give your complete name, affiliation, and email address. For today's open forum, we will be entertaining a number of questions based on our time limitation. Those questions which will not be entertained will be answered by our very generous resource speaker via email. I believe our viewers are very much excited for the open forum. Thus, without further ado, let us begin. We have the first question coming from Emil Kimura. Sir Jonathan, can we set an example of agricultural products to use the Markov model?
Yes, definitely we could use this model in any agricultural product as long as you know the price process of these agricultural products. But basically, we could use also the geometric Brownian motion or an Ornstein-Uhlenbeck process if you know that the price has a mean reversion property. The Markov model actually factors in the changing of the state from one state to another state and so on. So you have to set first the number of states, and you have to set also the price process of these agricultural products.
Thank you very much, sir. Related also to the question coming from Mr. Emil Kimura, I actually have my personal um, question because I am very much interested with your presentation, sir. Um, in the recent years, sir, the biggest driver of the high inflation rate was food prices, and some key agriculture products, primarily rice, sugar, and corn, were some of the supply and price headaches which significantly affect on inflation. Um, Sir, how do you think may the hidden Markov model help the agricultural commodity market in the Philippines to progress and resurrect?
Hmm. That is a very difficult question. How to help with this price as well. The good thing about the hidden Markov model is you get a clearer picture on how the price changes. Okay. Then once you have the clearer picture of how the price changes, you can have or you can take some precautionary measures because there are also some researches related to hidden Markov model that identify some warning signals if there will be an economic downturn or economic turmoil that will happen in the near future. So we could also extend this study to determine or to identify some warning signals that will give us some idea when will that downturn will be. I
I
hope that
under
I answer your question.
I understand, sir. Sir, at present, have you encountered some researches regarding this application in the agricultural sector, if any?
In the agricultural sector, uh, a colleague of mine is actually doing research on fisheries. She is a faculty in the University of the Philippines, Visayas. Uh, a friend of mine from Italy is working on price changes of lumber, the trees, lumber, and my supervisor works on electricity and also temperature. The changes in temperature that affects the weather patterns.
Thank you, sir. Thank you, sir. Um, Well, we are waiting, sir, for more questions coming from audience. I will take this opportunity to ask my
Sure.
personal question, sir. Sir, in your lecture, you have discussed more on the technical aspect, of course, of the hidden Markov model and its application to your research, specifically with the heavy metals that you have indicated. Um, I am also interested, sir, with the strengths and weaknesses of the hidden Markov model in the commodity market in general, sir. Can you enumerate some, sir, if there are any of these advantages and disadvantages as we applied it in the commodity market, sir?
Okay. One advantage of that is, of course, we are considering several states because in the usual pattern or in the usual modeling framework, we just have one state wherein given a state or given a price process, given a model, you determine the parameters. In this framework, we are considering several states, so the prices allows some flexibility that it changes dependent on the price. Uh, one one disadvantage that I can think of is the identification of these states. What do these states really mean? Because in my presentation a while ago, I just gave uh, some personal interpretation of these states, but we don't know what really these states are.
Thank
Did
you
I
very
answer your question?
Yes, sir. Yes, sir. Actually, sir, in your earlier presentation slides, I saw some of the graphs, and honestly, sir, previously, I am very much interested with the stock market, and in which we can see some of the changes, of course, and I believe it can also be applied in stock market and other similar areas, sir. No, we have another question here coming from um, Miss Myra Oruga. I'm sorry. The question is from Miss, I think it's Tramboa Ana Victoria. I didn't understand those equations or calculations, but I understood very well the precious metals and I gained information on how it changes its price. I'm sorry, it's not a question, but rather a comment coming from one of our viewers. Let me also read some of the comments from our viewers. From Jonathan Legaspi Texon, he said, Sir Jonathan, thank you for imparting the knowledge. Likewise, we also have a comment from Ulchi Sakaino. Sir Jonathan, I have idea in this Markov model, but in this presentation, I gain more ideas. I believe our audience enjoyed and become more knowledgeable about this hidden Markov model as they watch and listen to your presentation, sir. And I believe they are very lucky to be part of this um, Futures Research webinar series. I guess we don't have more questions coming from audience. I am very sure that they fully understand the discussion, or probably they are still thinking of more relevant questions to ask. And if in case our audience would like to still give their questions, you can still comment your questions via the different platforms of the UPOU. Okay. So ito, meron tayong mga incoming questions pa. Sir, can we still continue on our Q&A? This one came from Chazel Eunice Casanova. Sir, good morning. I would just like to ask what is your opinion on how the Markov model can be used for us to avoid global financial crisis?
Uh, in my opinion, hidden Markov model cannot be used to to avoid global financial crisis, but it can help us determine if there is a global financial crisis. So it is not really a way that to it is not really a way to avoid global financial crisis, but we can take this model to give us some warnings or to give us some signals if there will be a global financial crisis. And if that is the case, you can make some measures or some actions to decrease or to lower down maybe perhaps the crisis.
Thank you very much, Sir Jonathan. I think you have answered the question of Miss Chazel Eunice. We have another question. I guess this is a clarification from Miss Heidelin Pimentel. Can the Sir Jonathan, can the model be applied in policing like modeling and simulation? Based on my understanding of the model, I think it can mathematically describe like the police suspect interaction. Is that correct, sir?
Uh, policing, policing like modeling and simulation. What do you mean by here? Policymakers?
I think so, sir.
Yeah. Well, I will just answer it based from my understanding of the question. Well, yeah, you could use the model. As I've mentioned a while ago, we could use this as a warning signal for some changes in the states or some changes in the parameters. So you could use that to you could use that for your modeling and simulation.
Thank you, sir. Miss Heidelin, I guess Sir Jonathan have answered your question. If in case you would like
Yeah.
to give a follow-up question, sir, right, you may comment your follow-up question to Sir Jonathan. We are having more questions, sir. Next is we have a question coming from Mr. William Salige. Sir Jonathan, how important is Markov process in analyzing the reliability function and availability system of sugar industry like in Negros?
Wow, that is a very specific question. I am not familiar with the sugar industry in Negros. Maybe we could look at it. But in my perspective, it is better to look at the prices because, and once you have already the prices of this sugar, we could use it to determine the parameters if we have the right model and right assumptions. And from that, maybe we could gain some information.
Thank you, Sir Jonathan. We have another question coming from Sumendra Mishra. Sir Jonathan, can this model be extended to fluctuating option prices? And if so, how coherent could it stand to Black and Scholl's pricing model?
Yes, definitely. It could be extended to the fluctuating option prices. And there are already available papers considering this. So they just extended the Black-Scholes model to a multi-state framework wherein they used the hidden Markov model. My advisor already did some calculations of that. And my future undertaking is to use the Black-Scholes model to price several options.
Thank you very much, Sir Jonathan. We have the clarification coming from Ms. Heidelin Pimentel regarding her previous question a while ago. Sorry, she is referring to police law enforcement, sir.
Law enforcement. Yeah, you could use that. The important thing is once you have the parameters, it is very important to determine how you could use these parameters for your further analysis.
Thank you very much, Sir Jonathan. I believe okay, there's more question coming from Frances Mituda. Hello, Sir Jonathan. Is there an available HMM software that we can use, or is it something that is manually calculated?
Yes, there are lots of available softwares that you could use. There are packages in R, if you are familiar with R, and also in Python. There are packages in hidden Markov model packages in Python. I am not sure if it is also available in MATLAB. I have not yet explored that. But in the research that I made, I actually use my own algorithm. I did not use any of the softwares available.
Thank you, sir. Let me read another comment from one of our viewers, from Mr. Eds Mercado. Sir Jonathan, thank you po for this very insightful webinar. Ayan. Sir Jonathan, I believe you are open for doing collaboration researches, right, sir? With respect to application of hidden Markov model into, of course, different markets or commodities, sir.
Yes, definitely. I am open to some collaborations. Well, right now, I'm also thinking of extending this research to some uh, real assets. When we say real assets, the to some assets that can still be mined on the ground, like oil, and also some renewable energies, the windmills, the solar energy, biofuels. Okay, there are actually lots of research areas that can be where hidden Markov model can be used.
Thank you, sir. Let me read another comment from one of our viewers, Ms. Zenaida Villafuerte. Sir Jonathan, thank you for this kind of discussion. It is helpful for researchers like us to gain learning from experts like you. Thank you and God bless. Now we have another question from Mr. Ryan Panugao. Sir Jonathan, I am an elementary teacher, and my basic question is how can I apply the model in my lessons? How can you give us an explicit example for its application? Thank you very much.
That is a very difficult question. If you are an elementary teacher and you want, well, if you are fond of doing research, not just applying the lessons that can be used to your students, uh, you can look at the prices of the stocks maybe, and maybe you could get some inferences if we use the hidden Markov model. Maybe I think that is the very basic idea that you can get to have some idea on how the prices of these stocks changes.
Thank you, sir. We also have another question from Miss Maggie. Do you think, Sir Jonathan, do you think the agricultural sector can utilize HMM to make our country attain maximum food security considering the erratic weather patterns in the Philippines?
I think this is a very difficult question, but we could use hidden Markov model to give us some insights. And actually, we could use this to study the weather patterns like amount of rainfall, temperature, uh, wind speed, because these weather parameters can greatly affect the crops, rice, corn, potatoes. Okay, so we could use this hidden Markov model to determine the states. The states that is very evident in the weather is a sunny day or a rainy day. Okay, so we could actually use that to to determine when to plant these crops. Okay, and also we could use that to determine the yield of these crops and so on.
Thank you very much, sir. Moving to our next question from Miss Cheryl Galvan. Sir Jonathan, is it possible to use the Markov model for survival analysis in this age?
In this age or
This
pre
age, in this
age?
age.
Oh, in this age. Survival analysis. Well, survival analysis is actually a different discussion. When we say survival analysis, is the survival analysis of the people, of the person. If that is the case, well, yeah, you could use that as long as you have the correct assumptions. If we are considering survival analysis of the people, you are considering the mortality. So you should have a good assumption of mortality, and we could incorporate Markov model to that model. But currently, I cannot think of a way on how to incorporate that Markov model. Well, that is actually a very good discussion for future research. That is interesting.
Thank you very much, Sir Jonathan. And thank you also, Miss Cheryl Galvan, because that, of course, leads to other possible topics in this future research series. I guess that's the last question coming from our viewers. And the number of questions that we had is a good indication that our participants are very much interested with our topic for today, specifically in the hidden Markov model in commodity market. So that concludes our question and answer portion for today's Research Conversations webinar. In behalf of the audience, I would like to thank our very generous research speaker, Sir Jonathan Mamplata, for answering all the questions and for that very informative and inspiring discussions. Once again, I am Arman Santos and am now turning over the program to Miss Jessica. Thank you very much and good morning.
Thank you for facilitating our question and answer, Mr. Arman. And of course, thank you, Mr. Jonathan, for sharing your research expertise in the hidden Markov model. Indeed, this model is useful in observing and determining underlying certain parameters for further improvement or advancement in our commodity market. So, for everyone, we would like to remind you that the link and QR code of the evaluation form will be provided at the end of this webinar. And in order to receive an e-certificate from this webinar, kindly accomplish the evaluation form. So we also want to ask you to double check the details that you input in the form, especially your name, as it will appear on the certificate. Another reminder, the evaluation form will only be available within an hour after this live stream. So to close this webinar, I would like to call the Assistant to the Vice Chancellor for Academic Affairs in Research and Publications, Dr. Myra Uruga. Dr. Myra?
Thank you, Jessica. Thank you, Prof. Jonathan Monplata and Assistant Prof. Arman Santos for wonderful engagement today. Indeed, a very valuable and timely topic. In behalf of the Office of the Vice Chancellor for Academic Affairs, our head, Dr. Melinda Lumanta, our Chancellor, Dr. Belinda Bandalaria, Vice Chancellor of Finance, Dr. Jean Saludades, our collaborative faculty, Faculty of Education, headed by Dean Dr. Ricardo Bagarinao, our Director for Multimedia Center, Lisa Helisan, and Dr. Joanne Serrano of UPOU Public Affairs. I have been browsing our networks and saw the diversity of our audience from Luzon to Mindanao, all the way to other Asian and European countries. Again, thank you very much for your participation. Hidden Markov model in commodity market is a new concept. It is indeed a future research. They have a lot of uses as mentioned by Assistant Prof. Mamplata. It is a generative models in which the joint distribution of observations and hidden states or equivalently both the prior distribution of hidden status, the transition possibilities, and conditional distribution of observation given states, the emission probabilities is modeled. Also, I understood that it is a statistical model based on what Mamplata have shown to us. Okay, it can be used to describe the evolution of observable events that depend on internal factors which are not directly observable. The hidden states form a Markov chain, and the probability distribution of the observed symbol depends on the underlying states. In his talk, he explains the following concepts, particularly precious metals, electricity, futures in market settings, numerical implementation, to name a few. He also discusses commodity market and explain it and give some examples. Concept mentions what futures is about. A financial contracts allow investors to speculate, used to hedge the price movement. He also explained this variable or concept of convenience yield, benefited associate with holding an underlying product or physical good synonymous to dividend. Shows a sort of pathways of hidden Markov model or what he called Markov chains. He presented also four basic questions for HMM or hidden Markov model. How do we define this? Probabilities. What is the probability that a random day is sunny or rainy? If today is a happy, what is the probability that it's sunny or rainy? If for 3 days he is happy, grumpy, happy, what was the weather? Later on, I will ask Prof. Mamplata because I'm a healthcare practitioner. I wanted to associate it also. Fluctuations of prices in the commodity considered in the presentation as an example are precious metals. He also shows some technical formulas. I'm a nomad person. I really am confused on the some symbols that he presented. He also presented the concept of geometric Brownian movement or the GBM, satisfying stochastic differential equation and its relationship to HMM. As part of his conclusion, he gave us an idea on what are the applications of this HMM, multifactorial model of GMB. It can be used in investment strategies, the mean variance strategies, pricing derivatives, securities under multi-state, multi-factor, and multivariate framework. I wonder if HMM, Prof. Manplata, can be used to predict love in the future or apply it for women's mood before and after pregnancy or before and after menstruation? Because I am a health expert, I wanted to know if HMM, if then that can be part of the prediction, then we can collaborate on this area. Okay? As well as to know women experiencing mood swings and how we control the level of estrogen and progesterone so that their husband would not be complaining. All right? This is on the point of view of a healthcare practitioners. Indeed, HMM is forecasting and prediction. We can be which can be applied to real life scenarios. Again, to our resource speaker, Assistant Prof. Mamplata, maraming salamat sa iyo. I am Dr. Myra Uruga. I would like to invite you again for another interesting futures research conversation. This time it's a collaboration between the Faculty of Management and Development Studies. Our speaker is the famous Dr. Darwin Bandoy, who is very active in IATF, supporting our Philippine government in COVID-19. The title of his presentation is Key COVID-19, 19 Pandemic Metrics from the Philippines. Again, magandang umaga po sa inyong lahat at maraming salamat sa panonood.
Thank you po.
Thank you. We're done. Congratulations.